Hello and good morning, everyone. Welcome back to Almus Market, your daily dose of global financial updates with me, Swaraj. There's a heavy downpour here in Mumbai, and even umbrellas sometimes don't protect you from splashes of rain. It's true even for markets. In the downpour of news and opinions, the noise often seeps in and opinions take shape of facts. While legendary people like Bill Ackman and even Elon Musk have been vocal about why Fed should not hike in its upcoming meeting to protect the banking sector, it's to be seen how it seeps into Fed's actions and dot plot. JK, good morning. How are you reading the market sentiment going into FOMC?
Yeah, good morning, Swaraj. Yes, it's a very mixed sentiment and more on the side of caution, I would say. And yesterday was really a volatile day following the weekend deal for the crude exchange takeover by UBS. Though overall, the deal seems to have found some cautious acceptance by the market. Markets are definitely swinging with alternate bouts of renewed contagion fears on the one side and worst having been seen on the other. And this is not likely to give relief very fast, even as everyone watches what the next development could be and how authorities would be dealing with it. Although Credit Suisse deal was seemingly a relief, with the worst being averted due to UBS takeover, the fact that a large section of investors had to take a huge hit on the 81 bonds being written off has set off a sense of fear about whether more is in store. The impact of these losses is also showing up in the intermittent sell-off in risk assets that we have been seeing. Yields saw a new low yesterday, being hit before recovering. The key two-year yield fell to a fresh cycle low of 3.6350 before recovering to 3.9240 by the close. And the German two-year yield saw a low of 2.0890, which is 1.3% lower than the peak that was seen on 9th March. And this shows the extent of safe haven buying that's happening by selling risk assets, and also reflects the view of the market that official rates are sooner or later headed lower. And the futures are showing a good probability of a pause by Fed, a reversal from the end of last week when the markets were pricing in 25 basis point hike. Interesting to read the Wall Street Journal piece, because that is considered as a mouthpiece for the Fed. And they say that if the banking crisis passes more quickly, a decision to pass rate rises risks worsening inflation problem by igniting a market rally that counterproductively eases financial conditions. Other former policymakers do see a persuasive case against an increase this week. So the view is slowly emerging that Fed pursues lending standards tightening more. They could opt for a pause, as the inflation may be automatically addressed due to tightening financial conditions and probably higher unemployment, due to the financial sector problems. And Fed's job may be done by the market. That is what the hopes are, seeming to be coming. Stocks did one more upside yesterday. Some positive reaction coming from credit share resolution, and more after expectation of a pause by Fed rising. All indices in US were positive. So was the global composite index. A rally in regional banks actually added to the positive sentiment. A report said that subsidiary of New York Community, Bank Corp, has entered into an agreement with US regulators to buy deposits and loans from Signature Bank. And on a concerning note, of course, even as news was emanating that head of JP Morgan was leading efforts to craft a new First Republic Bank rescue plan, the shares of the bank, bucked gains in the Wall Street by cratering almost 47% after S&P Global downgraded its credit rating deeper into junk on Sunday. Credit shares slumped more than 55%, while those of UBS, who is taking over, fell nearly 60% at one point of time, but recovered to close slightly positive. And there is a report saying that bank deposits in the US outflows has actually stabilized, and most vulnerable institutions are not seeing much outflows as of now, and in some cases it is even reversing. Technically, a short-term base seems to be formed for stocks, which can result in a bear market rally on a further improvement in the sentiment. But it's very difficult because so many moving parts in the market. The currencies with so much negative news, mostly surrounding US financial system and the economy, dollar continues to carry a negative bias. Expectation that Fed may go for a pause only added to fresh weakness, particularly in GBP and Euro, even as authorities in Europe continue to reiterate soundness of their banking system. In fact, Lagarde said that without tensions, they would have indicated further rate hikes needed for the European region. Then on the rupee, nothing new that is happening. It's still holding on to ranges, but if anything, the base seems to have risen to just under 82.50, where a good buying is seen. Outflows from stock market sell-off has been keeping it well supported. While the sellers are still very hesitant, despite premium jumping to 2.5% per annum annually, and that I think that shows the amount of uncertainty and the caution among the investors, and the more so with the exporters also, who don't want to commit too much. They their feeling is that things are not settling down, so they want to be selling as less as possible as of now. But I think the next 10 days would be crucial for the rupee as well, because in case the global sentiment improves, then we might see better sessions for the INR. But underlying sentiment is still yet to take a good reversal to the upside. Thank you.
Thank you, JK. And just to summarize, sentiment remains on the side of caution. Markets are still digesting the UBS acquisition of Credit Suisse. What's interesting is that on the UBS website, it shows as an acquisition, while on a Credit Suisse website, it shows as a merger. So definitely there's some sort of divergence in the narrative. On the yields front, the 2-year saw a new low yesterday of 3.6350% before recovering. There is a lot of safe haven buying which is happening, and also market is pricing a pause rather than a 25 basis hike for the upcoming US FOMC meeting. The First Republic Bank continues to be in trouble, yesterday rated as junk by S&P, while the weakness in USD is continuing because, of course, the narrative in the US is that there won't be a rate hike, while central banks like the one in Europe and UK are continuing to maintain their soundness of financial sector. While on the domestic front, rupee continues to be in a range, and premiums have jumped to 2.5% annualized. That's it for today. Tomorrow, it's a holiday on account of Gudi Padwa here in India. We wish all our listeners celebrating a very happy Gudi Padwa. And just to inform you, the currency segment will be closed tomorrow. So ensure your risk management practices are in place. We'll see you all on Thursday with the latest developments on the FOMC. Thank you so much for listening.